Welcome to Endowus Access live webinars. This is the third in our series of ESG sustainable investing. Really excited to be here with some amazing speakers. Today's webinar is the next one from last week when we touched upon investing in a better future through the lens of an equities investor. This week is fixed income investors. And so really excited to have four speakers other than myself. We have, to begin with, Lupin Raman, who's joining us from PIMCO. Want to say hi?
Hi there.
Okay, great. And then we also have Marika, who's joining us from J.P.Morgan Asset Management. Oh, Marika's frozen. So we come back to Marika. We're having some internet issues, but Marika,
hello.
You're back.
Thanks for having me.
Okay, great. And Eric Keller from Robeco in Rotterdam.
Hello, everyone.
Okay, and then also Victor Wong, who's the head of sustainability at UOB Asset Management here in Singapore.
Hi, everyone, and good evening and good morning.
Okay, wonderful.
Yeah.
So we're going to kick right in, some disclaimers for everybody. If you can all mute yourselves, that'd be great. And we have the slider poll. So if you have any questions to ask the panelists here, then please go to the slider poll. On the YouTube channel, you have links underneath, which will have the slider poll. Also, you can go and ask. So we're going to kick right in, some disclaimers for everybody. Sorry, 1 second. We actually have ESG portfolio details underneath, and then you can also schedule a call with our MAS licensed representative. So please check it out. If you have slider poll, then you can put in questions. If you don't want to ask questions, you can actually go in and select and upvote the questions that you want to ask. So we'll address that. But please bear with us. We'll have to go through the presentation, and then also we're going to have some prepared questions, and then we'll address the questions from the audience later towards the end. For those that are not familiar with Endowus and seeing us and joining us for the first time, then Endowus, just a quick brief intro on Endowus. Endowus has a mission of trying to help people invest better so they can live easier today, to live better tomorrow, and through retirement. Asia's wealth and investing experience is very broken. It's a very painful process. We experienced it ourselves, and we're trying to solve it for all of us. And the problems are largely an issue of lack of aligned advice, lack of access to great products, and high cost. This leads to poor outcomes. So Endowus was really created to provide a digital and hyper-personalized and also holistic solution to your wealth experience, and giving access to better financial products at lower cost, which leads to better outcomes. And the ESG sustainable portfolios are a prime example of that. These funds, which are traditionally the purview of institutional investors, is now readily available, working with our great partners here today to make it readily available to retail investors. So Endowus is famous for being the first and only digital advisor for CPF investing. But it's not just for CPF, it's for all of your wealth needs. And it is, as a result, the only digital platform where you can manage all of your source of funds, CPF, cash, and SRS. We focus on a few things and try to do that well. And those three things are advice, access, and cost. And we are independent and strictly fee only. So we're advancing the cause of fair fees. We're also working always in the best interest of the clients to do our fiduciary duty. And we're approaching this wealth advisory service through a digital platform, but we want to be holistic and always working for you. We work and stand on the shoulder of giants. We partner with some of the largest global and local fund managers who are here today joining us, who manage combined, I think it's more than 20 trillion, probably 30 trillion. If you count all of them, over 30, 40 fund managers with multiple products, but always focusing on providing the best-in-class products at the lowest cost to our investors. We launched our sustainable portfolio just 2 weeks ago, just over 2 weeks ago. It's available for cash. It's soon to be available for SRS, and we are busily preparing the CPF portfolios. You can go in and invest right now. We have 6 of the leading portfolio managers who have enabled this. We had Mirova, Natixis, and Schroders last week doing the equities portion. And today we have the 4 fund managers today doing fixed income. So really unique solution for retail investors, Sing dollar denominators or hedged back to Singapore dollars, access to institutional share classes, and really solving for sophisticated ESG investing. And these portfolios can be risk targeted across the whole spectrum from 100% equity to 100% fixed income. All the people in this panel today want you to invest in the 100% fixed income portfolio. That's where all the money will go. So, but it's up to you according to your suitability and your risk. So please look at it and analyze it and make the right choices. And, just some of the things that we've done to get here is work with these partners. 2 funds are even now only available on the Endowus platform here in Singapore. Many of us have worked to introduce new institutional or clean share classes here in Singapore. Many of them are providing, exceptionally low fees and trailer fee rebates in order to get to a lower net fee. So it is exclusive access and lowest cost. At this point, I'm going to pass over to our first speaker. Ladies will go first. So Lupin, if you can introduce yourself and PIMCO and how PIMCO does sustainability investing.
Very good. Thank you very much for having me. My name is Lupin Raman. I'm an EVP at PIMCO and the head of EM Sovereign Credit and ESG Integration. PIMCO is one of the largest fixed income investors with a global presence and about 2.2 trillion in assets under management. Our sustainable investing business began in 1989 with one of the industry's first negative screening bond strategies. And this was followed by a suite of strategies focusing on sustainability and being a signatory of the PRI in 2011. I'm excited to let you know that PIMCO's climate bond strategy is the newest addition to our ESG suite and specifically allocates capital to bonds addressing a sustainability theme. And in this case, it is climate. It offers a multi-sector credit portfolio that aims to help foster the transition to a net zero carbon economy while seeking risk-adjusted returns comparable to an investment grade portfolio. Our approach to ESG integration focuses on 3 pillars: exclusion, evaluation, and engagement. We exclude issuers which are misaligned with our views on sustainability. We conduct in-house evaluation of all issuers that are in our ESG funds, and we seek to engage proactively with all issuers on key sustainability themes. We think that these 3 pillars really afford us a very significant bottom-up assessment of key ESG considerations and how they should fit into our portfolios. Let me stop here and hand it back to the moderator.
Okay, great, Lupin. Thank you so much. We're going to move on to J.P.Morgan and Marika. If you can introduce yourself.
Great, thank you. And apologies for the tech issues earlier. Hopefully you can all hear me loud and clear. My name is Marika Desenchuk. I'm an investment specialist in the Global Fixed Income Currency and Commodities Group at J.P.Morgan Asset Management. I've been with the firm for about 10 years, first in New York and now in London. And I head up our multi-sector fixed income strategies. So that's primarily our unconstrained or go anywhere flexible fixed income portfolios, as well as our aggregate and rate strategies. And most recently, my focus has been essentially entirely on our sustainable fixed income offerings, as we've launched an explicitly sustainable version of one of our flagship unconstrained strategies. And I'm sure we'll get into that in a bit later. J.P.Morgan Asset Management has been in operation since 1863, so literally centuries of experience. We operate across all asset classes and all regions globally, so in 20 different countries. And we have over $2 trillion in assets under management. Do we want to go to the slides now, or?
Yep, I'm in the slides.
Great. If we look at the first page, at the heart of our approach to ESG investing and sustainable investing at J.P.Morgan Asset Management really is proprietary research. So this means that ESG considerations are embedded within our deeply resourced research teams. And ultimately, we believe that this allows us to develop and build customized solutions for our clients, and importantly, to reflect their values. And you can see that our commitment to sustainable investing dates back decades. So just a few key highlights. In 2007, we became signatories to the United Nations Principles for Responsible Investing. In 2016, we established our Sustainable Investment Leadership Team. And that's really what started us off on this path that we've been on for the past 5 years to progress our sustainable investing capabilities. That was also when we formalized our commitment to ESG integration, which is something that we've been doing for years. But again, this is the formal commitment that we made to that approach. And this Sustainable Investing Leadership Team, together with our dedicated Sustainable Investing Team, uses a structured 10-point system for assessing every single strategy and team across J.P.Morgan Asset Management to determine whether or not they are ESG integrated. So we have this rigorous approval process in order to get that stamp, if you will, of ESG integration. So it really covers every element of the process, from research, portfolio management, risk management, portfolio construction, making sure that everything is documented and embedded within our systems. If we turn to the next slide, sustainable investing, really importantly, is not a standalone isolated effort at J.P.Morgan Asset Management. Rather, it's embedded within everything that we do from an investment standpoint. And you can see that our sustainable investing team reports up through the heads of our investment desks. We also have a very collaborative approach across each of our investment teams across asset classes with our sustainable investing team to make sure that we're considering sustainability in the context of investing in each of these different markets. If we maybe shift just briefly to thinking about fixed income specifically at J.P.Morgan Asset Management, on the next slide, you can see that we manage $690 billion in fixed income across all types of strategies. And this entire platform is ESG integrated. Now, I mentioned before, we have this focus on research across our entire asset management business. And again, that's reflected within our fixed income platform specifically. So we have a deeply resourced team of 270 fixed income investors. Ultimately, every single bond that we purchase in one of our portfolios has been researched in-house by our dedicated research analysts. And this really goes back to the fact that as bond investors, we view ourselves as lenders of our clients' money. Therefore, we really want to make sure that we can get that money back with interest. And you can see that our approach to ESG in fixed income is embedded within our research framework, in which every investment idea that we have is assessed based on the same three filters of fundamental, quantitative, and technical analysis. And ESG is no different from that and is directly embedded within that. So ESG is not a side thought for us or a separate consideration. It's something that we assess alongside the credit metrics of each bond that we assess. Maybe at that point, I'll pause and we can get into the specific strategy later, but hopefully that gives a bit of introduction to how we think about it at J.P.Morgan Asset Management.
Wonderful, Marika. Thank you so much. We're going to move on to UOB Asset Management, and Victor, if you can introduce yourself, and then if you can also introduce Eric at the end so that it flows into Eric, that'll be great.
Sure, Sam. Thanks, Sam, and thanks for inviting us on this webinar. And of course, those of you who are based in Singapore, I think UOB needs no introduction. UOB Asset Management has been in the business of doing investments for over 30 years now. Now, if you look at this slide, I would like you to pay attention to the very top of the word. We have made it an objective, a purpose, a statement to embed sustainability into the company's DNA. The four strategic pillars we have here, digital first, keeping customers at the center, are very important to us. But today, for the purpose of today's session, look at the middle two, focusing on sustainability. I think we really believe it is possible to invest for both profit and purpose. And of course, the other part about shaping a better world for future generations, I think even as investment managers, as members of the investment community, we can and we should play a role in this. And I think we are very proud of our Asian heritage. We have offices across the region. We are strong in ASEAN. And we think when we combine the two, our investment DNA, our focus on sustainability and tapping our expertise and the in-depth knowledge of the local Asian markets actually gives us the ability to actually effectively implement sustainable investing into our investment process. And turning to the next slide, our journey may be a bit shorter than some of my peers here, but being a little bit, when we joined, say, for example, PRI only last year, it forces us to run a little bit harder, a little bit faster. So what we do now is that we realize that we have the investment background, we have the investment expertise. We signed on to the PRI last year, and we found that there was a need, a very strong need, especially in the Asian region, to develop local expertise and not just in fundamental research. And that's why if you focus on the top right of the slide, we have decided after starting the dedicated sustainability office in Singapore, we are going to roll this out to all our offices around the region. So after Singapore, we're going to do this year. We're in the midst of doing this now to Malaysia, Thailand, Indonesia, Taiwan, to Brunei, and our latest office in Vietnam. And as some of you will appreciate, these are markets where some of these are frontier markets. And when you mention ESG or sustainable investing to these markets, it's a very new concept. So we're very happy, we're very excited to be playing a key role here. I think we can add value to increase awareness. We can start to promote sustainable investing, because I think this is really the start of a mega trend as far as sustainable investing is concerned. And earlier I had a conversation with Sam, and we're talking about the outlook for Asia. And here I think I'm very happy to say that we have seen top-down initiatives, countries in China, South Korea, Japan announcing very ambitious targets. And here, even in our home country in Singapore, the government has come up with the Green Plan 2030. And when you look at these national agendas, I think the growth outlook for sustainable investing in this space is very strong. So again, UOBAM is very happy that we are able to play a part in this. And besides enhancing our own internal capabilities, where the likes of Robeco and Fukuoka Capital Management come in, is these are our strategic partners. And I've promised Sam as well, we will introduce Robeco because we are like-minded partners. We share the same vision. We share the same potential for Asia in terms of sustainable investing. So last year, we launched Singapore's first bond fund in terms of sustainability. It is aligned to the UN SDGs. It allows investors to access 3 megatrends, climate change, cybersecurity, rising inequality, something unique. And I think, again, the conversation has pivoted from, do I need to do sustainable investing? Do I need to learn more? To, I want to do it. Give me the products, tell me your strategies, and you can help me align my values with investing. So I think that's the part UOBAM can play here. Back to you, Sam, or maybe to Eric then, Robeco.
Thank you. Thank you. Indeed. Thanks, everyone. My name is Eric Keller. I'm part of Robeco's credit team with a focus on our sustainability credit strategies, and especially, as alluded, the strategies that are aligned with the UN Sustainable Development Goals. So indeed, if we can move past the disclaimer. The ESG is really part of Robeco's DNA. We've been integrating sustainability since 1995 through our affiliate Robeco SAM, which has mapped corporate sustainability ratings for companies globally. And it's been integrated across all our strategies currently. So all Robeco's credit and fixed income strategies are all ESG integrated. Specifically for the credit strategies, we've been doing this since 2010. And we think it's a very important additional insight. As fixed income investors, we're obsessed about downside credit risk. And we have seen that incorporating ESG in credit analysis really helps to reduce defaults, have lower credit risk compared to mainstream portfolios. So that is a very important way of applying ESG alongside, and I think that's also something we've done for quite some time, since 2005, being active owner and active engager with companies. We think it's very valuable to not just exclude a company, but first try to engage on topics like biodiversity, climate change, with the aim of improving a company's sustainability profile. And then when that's unsuccessful, we can ultimately decide to exclude a company. Well, the more recent development that we've seen is the publication of the UN Sustainable Development Goals, which we think are clear blueprints for sustainable growth. And we've developed and launched different SDG credit strategies. And perhaps we can move on to the next slide. And what we've done as Robeco, we've developed, this is about can we make a distinction between, sorry, to stay on the other slide. Basically, there are two streams within sustainability: ESG integration, which is something we've been doing for a long time, very valuable additional insight in credit investing. And the other sleeve is impact investing, so really creating a credit portfolio with the aim of having a positive impact on society, on the SDGs, on climate change. And so this is where really we've been active and launched different strategies. And specifically, when we look at the UN Sustainable Development Goals, we've developed a framework to assess a company's impact on the UN Sustainable Development Goals by looking both at what companies are producing, what are the products and services, are they aligned with the UN Sustainable Development Goals, how do company operates, if we look at environmental practices, governance, and do we see ways in the way that company operates, is that also aligned with the SDGs, and if companies are involved in major controversies. And through this three-step assessment, we can identify what is the alignment of companies, and with the aim to exclude companies that do clear harm on the UN Sustainable Development Goals. And what is interesting to see, that's my last slide, is that we see that actually it also comes with a financial benefit. We see that typically the companies in sectors with a negative SDG assessment are also associated with more risk, more volatility, more downgrades, more defaults, and lower returns compared to investing in companies with a positive SDG assessment. And therefore, alongside a positive impact, there's also a clear financial benefit of the sustainability screening. And with that, I would like to give the floor back to Sam.
Great.
Yeah,
Thank you so much, Eric. Yeah. Thank you so much, everybody. Lupin, is there something you wanted to say, or should we move to the next segment?
No, let's move to the next segment.
Okay, wonderful. So I'm going to stop sharing, and we'll have all the speakers up on the screen so we can see each other. So I'm going to kick off, we did a session on equities last week, and there seems to be this perception that bond investors have lagged their equity counterparts in integrating ESG considerations in the investment process. I mean, some of these firms have been doing it for decades. So I know that some of you will disagree with that assessment. So maybe just as a warm-up question, we can just take turns about, sharing about, whether you actually believe that is true. Can ESG be done in fixed income? How is fixed income ESG investing different from equity? So maybe we'll start with Victor, because Victor actually has an equities background. So before you took on the sustainability role, so do you feel that this is possible, and some thoughts about that, equities versus fixed income?
Actually, Sam, to answer that, the answer is a yes, but qualified yes. When I started from the equity background, yes, it seemed smoother to integrate. So when I started the team in UOBAM, the sustainability office, we were looking at ways to demonstrate that we were actually getting increased outperformance. And yes, the numbers came out that you do get a bit of outperformance, you get lower volatility. And actually, we started to realize, look, the concept or the approach to looking at ESG investing for both asset classes remains quite the same. At the heart of the entire sustainable investing, what are we doing? I mean, it's not something that's just come on the scene in the last few years. It's something that we've been doing maybe in the background, right? For governance, for example, we've always incorporated some sort of environmental and social issues into the fundamental approach. But what has come to the forefront is the availability of more data, more disclosure, and it's allowed us to fine-tune exactly how we look at the different asset classes. So I would say that looking at both equity and fixed income, yes, definitely yes. We are now beginning to find a common way to engage both asset classes as well. And that has always been in the past a key issue, right? Can you do engagement for equities? No problem. Can you do it for fixed income? And it's always been, I can't do that. But here at UOBAM, we have found a way that I think will allow us to engage both asset classes. And when we go to companies, in fact, we're beginning to see companies beginning to get prepared to answer both types of investors, because the questions are in a way starting to converge, the issues are starting to converge. And that's why I think it is definitely possible.
Eric, obviously Robeco has been doing it for a very long time. Wondering if you can comment very briefly on this.
Yeah, sure. No, I mean, definitely, we see the benefit of it, and we've been using ESG, and there we really look at, what are really downside risks. So can ESG translate into material downside risk for a company? And therefore, if that's the case, we want to downgrade an assessment. So I think that has been a very valuable insight as credit investors really focused on avoiding the losers in respect of picking the winners, but also in terms of creating an impact portfolio. So identifying companies that positively impact sustainability. We've seen also there the clear benefit, and I would say also the growth, as you get more data available to make that assessment.
Maybe Marika, we're going in reverse order, I guess. So Marika, maybe the history of ESG investing income.
Yeah, certainly. I mean, as you say, I think it tended to be kind of born in the equity space, but it's no doubt made its way to fixed income. But I think that there are some unique differences between how you think about ESG integration and sustainable investing in the credit markets and fixed income versus equities. And really just the starting point itself is more complex in fixed income, right? So you think about equities investing, you're investing in public companies. You switch to the fixed income markets, not only are we looking at companies, we're looking at countries. I'm sure Lupin has some interesting comments on that, being in the EM sovereign space. We're looking at securitizations, currencies. And not only are we looking at public companies, but obviously private companies also issue debt. And there become some increased challenges around disclosure, and transparency oftentimes is not as much in the private company space. So those are some unique challenges and differences we need to think about as fixed income investors. Also, you think about it's not just at the parent company level. Different entities within those parent companies issue debt. So we really need to make sure that we're being more detailed in our research to really identify which entity are we lending to, because those different entities underneath the parent company can have materially different ESG profiles. But all of that said, so there are certainly some differences, some unique challenges. I think going back to something that Eric mentioned at the start in terms of downside credit risk, I'd say arguably it's extremely important and extremely relevant to be doing this ESG integration in fixed income. You think about, as a fixed income investor, or fixed income markets themselves have this asymmetric risk profile, right? There's a lot of downside and limited upside. At the end of the day, you get par back, hopefully, otherwise the bond has defaulted. And so given that asymmetric risk profile, I think it's really important to consider all of the risks, including the ESG considerations when you make an investment.
Yeah. And last but not least, Lupin, on the slide that you actually skimmed through very quickly, it says 1989 was PIMCO's first managed social responsible separate account. But how has that evolved? And maybe you can touch upon the question as well, more broadly.
Absolutely. Yeah. So I think that, thinking about ESG and fixed income isn't significantly different than thinking about it in the equity space. If you believe that, there are a couple of objectives of looking at and investing in ESG strategies. One is the risk mitigation factor, which other panelists have discussed, and the other is having a positive impact. And those two factors are more or less similar in both the equity and the fixed income space. I would argue the modalities of how to achieve those two things are different. And that's the key issue in terms of ESG integration in equity space versus fixed income space. In the fixed income space, I think that there are some positives and some benefits. And the key thing is just the breadth and depth of the market. You are touching across several different asset classes, not just in the corporate or the credit space. You have repeated interaction with the issuer. You may not be a shareholder, but this repeated interaction in the primary markets means that as an investor, you're able to engage with the issuer several times, if not more, across the lifespan of an investment, and therefore influence change, not only in terms of targets, but when issuers go off track or are doing very well. In addition to that, I think in the fixed income market, one is also able to tailor instruments to really focus on particular sustainability themes. And we've spoken a bit about the growth of the sustainable bond market, and we've seen that in the green bond space, now increasingly so in the social and the SDG linked instrument space. But this very specific tailoring can mean that asset owners that have key sustainability objectives can really hone down in terms of how they provide financing to these particular themes and how they can influence issuers to essentially address these themes. So I think that, for the market as a whole, the fixed income market definitely has accelerated in terms of integrating ESG and really thinking about investment strategies with an ESG perspective in mind. And I believe that just given the breadth and depth of the market, that there is a lot more scope in this part of the asset structures than perhaps in solely the equity space.
Great. Related to that question, I mean, when we think about equities, people naturally associate like passive investing with equities. Fixed income, you know, there's various views about, you know, whether passive investing actually works, you know, why we should be active investors. Most of you here are active investors, but, you know, is there a way to do passive ESG? The index is good enough. Maybe Marika and Lupin, you guys can maybe touch upon this. I have some other questions for Eric and Victor coming up afterwards. So the passive ESG, whether indexes actually work, maybe, you know, who wants to go first? Marika, you want to go first on that one?
Sure. So admittedly, passive is something very different to what we're focused on. So the global unconstrained sustainable strategy that we offer at J.P.Morgan Asset Management is by nature almost the opposite of passive. And we think that that's very important from an ESG perspective and sustainable investing perspective. So our approach is to take a completely benchmark agnostic approach. We start with a blank page and only invest in our highest conviction, best ideas. I think the benchmark discussion, again, even though we don't even have a benchmark for our strategy, is an interesting one, and whether or not to use a sustainable benchmark. I think up until now, many of the sustainable strategies that have dedicated sustainable benchmarks have tended to be passive. It'll be interesting to see going forward if that develops and evolves. I think, you know, one of the things that we see, you know, in terms of kind of similar vein is some of these third-party ESG data providers, and you know, whether they have a place in this overall discussion. I think there are definitely some benefits that these providers offer in terms of that kind of independent, objective measurement. And I suppose it's similar with using an ESG benchmark. Investors know what they're getting. You're investing in line with that, but I think you just need to fully know what it is that you're investing in, and you know, what type of ESG approach you want. Is it purely based on, for instance, exclusions, which can be built directly into these benchmarks? Is it, and here I'll leave it to Lupin to comment on, but you know, in terms of focusing on the green bond market, for instance, and investing in line with one of those indexes. On the other hand, you know, if you're taking more of an active engagement approach, like Eric spoke about, you know, then I think arguably maybe not focusing purely on an ESG benchmark might be the way to go.
And Lupin, if you can follow that up, because I know PIMCO's done a lot of research between active and passive investing in fixed income generally. And then if you could tie that into the ESG space, that'd be great.
Sure. So, you know, from our perspective, I think that focusing on active management in the ESG space makes a lot of sense, given the kind of strategies and kind of objectives many asset owners have in the ESG space, which is to have an impact. And there, you know, having just a passive strategy benchmarked against ESG oriented benchmark doesn't really get you all the way. There are some asset owners that actually prefer to have very bespoke strategies based on their assessment of what they want to achieve on the ESG landscape. And this can range from the types of exclusions they want to focus on and the types of evaluation themes they want to weigh more heavily, whether it's environmental pillars versus social pillars or governance pillars. So there, I think having a much more active strategy makes a lot more sense. I think just given the data considerations that we have in the ESG space as well, given that data often lags and real-time events often have quite a significant impact in market performance, being active in the ESG space may make maybe even more beneficial in terms of having superior risk-adjusted returns than simply being a passive investor. What we have found, though, is, you know, whether you are looking for a benchmarked approach versus a fully flexible approach really depends on the asset class in which you're investing in. So if you are looking at the investment grade portion of the fixed income asset class, perhaps you are able to have an actively managed portfolio that is able to offset some of the kind of natural exclusions that you would want to have, whether it's, you know, excluding fossil fuel intensive sectors or particular issuers that are not net zero aligned. The universe is much larger, so the tracking error in your portfolios will not be significantly different to a fully flexible mandate. In other sectors, for example, emerging markets, where quite a significant portion of the sector in and of itself may either be very heavily fossil fuel dependent or scoring very poorly on traditional ESG metrics, would mean that, you know, having a completely narrow focus on very high scoring ESG sovereigns would mean that, you know, really that investable universe becomes extremely concentrated. And they're having some kind of ESG oriented benchmark, while not a passive strategy, but as a marker in terms of helping asset owners really figure out what the trade-off that they're looking for in investing in this space is, becomes a lot more important.
Great. Thank you for that. And just Victor, do you think this goes against certain principles of investing, such as broad diversification or concentration risk? How do you reconcile that? I mean, is that more equities concepts that doesn't apply to fixed income? What do you think?
I think, Sam, again, taking a very broad look at the whole issue, right? I mean, we have talked about exclusions, for example. So if you take a strictly exclusionary kind of strategy, yes, you are excluding certain sectors. But if you take a step back and say that, let's say I'm going to invest according to the SDGs, for example, would that be excluding anything? Would that actually be saying that you have biased yourself against different sectors? You are now looking at a different strategy where you say that let's look for companies which have a positive impact. And I think that with this new data that's coming in, and data, the availability of third-party ESG data, for example, I think was talked about with some of my panelists as well. I think it was very interesting because I think that is a point that we feel very strongly about. Because when it comes to ESG data, it's too much data, too little data that's conflicting. How do I make sense of the whole thing, right? And if you ask different investors, you get different answers. So for us, the way we approach this is, let's say I have a starting point and I want to construct my own in-house ESG scoring for the system. Because I think all strategies have to be based on a measurable kind of score, something that's not just taken off the shelf. What we do is we do subscribe to third-party data. We then augment it, complement it with our own research. I mentioned earlier local expertise, and I think that's very important. Because when it comes to this, let's say you come to a company in Thailand, equity or fixed income issuer, it doesn't really matter, right? Language becomes an issue. Is there a third-party report on this Thai company? More often than not, the answer is no. So how do you start? Do you avoid this company because you have nothing to go on? Do you then gravitate towards the more well-researched companies? I think that's a missed opportunity for us. Because I think if you go down to the ground, speak to these companies, some of them actually they'll tell you that I have received a questionnaire from MSCI, for example, just to name an example. I don't know how to fill it. I don't have the resources to do it. But if I have someone who can explain that to me, tell me the benefits of doing so, then the disclosure starts, the data starts to come in. And then it comes back to the question, right? How do I then apply all this when I come to my strategy? So I think the starting point really, to better answer the question is, do you have a strong foundation? Do you have a good ESG rating for this company? Then you can go on to apply the different strategies. That's the way I would look at this.
Sam, if I may add a comment there as well, I think because a lot of the feedback we sometimes get, if you are building a very sustainable, focused or impact fixed income portfolio, don't you get too much concentration? And of course, we've seen on the equity side more thematic equity funds where you have in a portfolio of 30, 40 names. And obviously on the fixed income side, you do want to have a diversified portfolio to limit this downside credit risk. But I think we've seen even in our, the impact portfolios where we do screen out a portion of the universe that does harm to the UN SDGs, we still find enough names to build a diversified portfolio and also to still be comfortable in outperforming a mainstream index. And I think we've seen that within that universe, we can create alpha, we can find investment opportunities, although the fact that you do screen out part of the universe. I think that's very important for clients looking for a diversified fixed income portfolio, but still want to have this positive impact or positive sustainability profile.
Yeah, great. I was going to go
Maybe,
to you, Eric, anyway, but Marika, if you want to chime in, please.
Yeah, I was just going to chime in. I think, this is admittedly taking a much longer term view, but if we take a step back from all of this and think about why we're doing this, why do people invest sustainably? Ultimately, it's to drive positive change in the industry and the issuers, whether they're countries or companies that we're investing in. So, the question about kind of concentration risk or diversification risk. Ultimately, and again, this is a long-term trend, the universe of companies and issuers which have positive sustainability profiles should be increasing. And I think that's one of the really exciting things that we've seen even just over the past year or so, is a lot of commitment, especially in the environmental side, increasingly on the social side with the pandemic, to improve some of these things. And so really that should just broaden the universe of companies to invest in that have, and we've seen it, the energy space in particular and the growth of renewables. And so I think it's actually sometimes an expanded opportunity set and you don't have that concentration or diversification risk.
So one of the things that came up, we did a survey of over 1,000 people on ESG and sustainable investing. And some of the findings were very interesting. 93% plus were interested in ESG investing, but less than 30% were actually doing anything, even a single stock exposure. And the problems, the barriers were often, lack of education, knowledge. They didn't feel that they were comfortable investing in sustainable investing, lack of access to product. We've solved the second one, the access problem here together. But the first one is still a problem. And I think that, disclosure, transparency, all of these things are issues that we face as sustainable investors. But it's also a matter of trust. The issue of greenwashing comes up all the time in any conversation, even in our questionnaire board. And this is, I guess, to the earlier discussions about, third-party ESG scoring benchmarks versus proprietary. And everybody here espouses a proprietary process of investing in this space. And maybe Eric, you can start us off with, why we need to do our own, due diligence and research, why proprietary research is necessary, why we can't just rely on third-party resources and data. And, how do we build trust, avoid this greenwashing issue? We even have a question right now. Let me just read that. It was quite, sorry, what was the question? How do you know if a company is lying about their ESG activities? Really straightforward question. So, if you can just address that broad topic, and then we'll go to some others. Whoever wants to speak afterwards can jump in.
Yeah, sure. I think in general about the risk of greenwashing, I think what is helping is that, and we see that of course in Europe, the new regulation coming, SFDR regulation, where investors, companies, and asset managers need to disclose more clearly what they consider sustainability, how they integrate sustainability in investment strategies. So that will help to create a more level playing field, at least for investors seeking to invest in different sustainability products. In terms of assessing the companies and on their ESG metrics, I think this is also a reason why it's important to have proprietary research as well. Because in some cases, indeed, you don't get the transparency of the data, for specific companies or regions. Sometimes for some Asian companies, it might be more challenging. And I think ultimately what we see is that it's a combination of using external information, but it's about also proprietary research and how you integrate it too, and how you make it relevant for your investment decision. So indeed, just using external data sources will not do the trick and will not provide you with all the relevant information. And it's really important that, you as an active investor, you are able to engage with companies, to talk to companies and get this transparency. And I think this is why engagement and having this dialogue, and Lupin said it already, you have a sort of recurring interaction with companies issuing debt. So you have a recurring conversation where also there you want to make sure that you get the transparency before you are lending money to such a company. So I think also this, it's important to be active and to have proprietary resources to cover, to engage with companies, but it's not said that you cannot use any outside resource as well. I think it's about the combination and how you really integrate it into your, investment assessment.
If I could join in there, I agree. I agree very broadly with that comment, and I think that one thing to note about this field is that it's not necessarily any different in terms of what we do with in-house assessments of other credit factors. We have the credit rating agencies, but most of the large asset managers will have their own in-house credit team. The ESG field is a bit more challenging because of the data gaps and because there aren't consistent third-party providers that take a completely holistic approach to all facets of looking at sustainability. But having said that, the approach that we've taken in this space is really to assess an issuer's credentials at the issuer and the parent level rather than just simply the issue level. And I think some of the criticisms about issuers that are not necessarily green, trying to come with green projects, while they may be very ring-fenced in the actual project and the type of use of proceeds those projects are connected to, at the issuer level, there really isn't that much in terms of evidence of moving towards positive environmental targets and a more greener future. So I think that looking at the issuer level becomes really important, in addition to just assessing clear criteria for selected issuers. And also we make sure that we focus on climate leaders and not just issuers that are trying to transition and improve their credentials, because there are many sovereigns as well as corporates that are already leading, and because they're so high up in terms of not only their green credentials but their overall ESG credentials, they may not necessarily always come to the market with a green issue. So distinguishing between green issues, credentials of the issuer, as well as climate leaders, regardless of whether it's a green issue, I think is a critical aspect of investing in this field and avoiding greenwashing.
Okay, anybody else? No? Okay, great. We're going to move on. So over the last several years, the green bond market has, started being introduced, and then it's grown quite significantly. And so maybe Lupin or Eric can maybe give us a brief introduction to green bonds. Lupin, PIMCO has a specific climate bond fund. So maybe you can just introduce and explain, and then Eric can take on the question as well.
Sure. So, the green bond space, very briefly, is essentially instruments that are issued to finance climate-friendly or green projects. Usually the bond indentures have a use of proceeds clause, which really tie in the financing that is raised from these instruments to the specific green projects in question. There are other criteria, including reporting requirements, and in some cases you often have steps up or step downs within the instruments, which are tailored to specific targets. Those are more complex types of ESG and green bond issuance. Going to other types of issuances in this field, you also have SDG linked bonds, so bonds that are linked to either the renewables targets within the SDG goals or other climate targets. And those tend to be general use bonds, so bonds which finance general projects, and those usually are assigned to particular key performance indicators across the life of the bond. Now, this part of the fixed income asset class has grown quite rapidly from a very small base. We think that the potential for growth is quite significant given the nature of the green infrastructure projects that are growing in the EU and also across the world in Asia and the US. And so the scope for greater issuance and development of this market from various types of issuers, not only from the corporate, but also from the sovereign and municipality sector, is quite significant.
So Eric, if you can, there's a question in the audience saying that given there are no global green bond classifications, I don't know what this means, unlike S&P Fitch, how do investors and asset managers ensure these bonds are not greenwashed? So related to greenwashing again, but maybe you can address that.
No, I think Lupin already mentioned a few things there as well. I think it's important to do your own eligibility check and to really see, if you look at the project itself, how does it contribute to the environmental goals, how it's aligned with EU taxonomy, is there impact reporting, and indeed, does it fit the overall environmental strategy? So if you have a utility that is issuing green bonds for a solar park, but at the same time they're expanding in thermal coal, that's clearly not consistent with the overall environmental strategy. So that is a way that you, and of course also look at the corporate conduct of the issuer itself, where you really want to make your own assessment and that eligibility check. And yeah, we will not accept every green bond for being green bonds. So in a number of cases, we will say, well, this does not pass our check and we will not invest. I think another important element there as well is we can invest in green bonds across the different strategies. It's also a way to finance companies that are transitioning to renewables, but it's also, we also are still wanting to deliver financial returns as well. So, in our broader discretion portfolios, we do want to look at relative value as well in green bonds, and that can sometimes be quite challenging. So that is also a thing where, this is something you want to incorporate in your investment thinking. Is this really the most, in terms of relative value, is this the best opportunity currently? But I think it's a way, it's a growing market. As said, it's also, see more sovereigns issuing it as well, with social bonds, sustainability linked bonds as well. So I think it's a very additional way to allocate capital to companies transitioning to a better sustainability profile, to a more greener setup.
Related to that, Victor, do you think that, are there specific geographies or industries that tend to score better on the ESG front, and are ESG portfolios inevitably tilted towards such sectors?
Yeah, okay, that's a good question, because I think I jumped the gun earlier about talking about ESG data, right? And the level of disclosure in some of the emerging markets, clearly not on the same level with some of the developed markets. Now, if you go by third-party data providers, you tend to see these companies being penalized for lack of disclosure or lower levels of disclosure. So if you were to look at these, primarily just looking at just top high-level scores, you would tend to avoid companies like this. So what the approach we take is that, what we try to do is that, can we equalize this? Can we modify, adapt the scores? Can we take into account the different levels of ESG development in different countries, for example? If I were to compare even within Asia, a more developed economy versus a frontier economy, would it be fair to just take ESG data from a third-party source, look at it at very high levels and say, look, one is clearly superior to the other, and I would then invest in the better one? Would I be missing an opportunity? So what we have done is that, look, we've got equalized things. If I talk to a company, and this is where I agree with Eric, for example, when we meet them face to face, where we engage in a conversation with them, we try to understand where they're heading in the spends. They may not have done enough, but if the commitment is there and they're moving forward, then I know the momentum for this company, the outlook for this company is probably going to be quite positive. So I would then adjust this, for example. So I think even within the Asian space, for example, when we look at, we were listening earlier about the green bonds. One common complaint has always been the lack of liquidity in this market, right? So companies that are coming out, being encouraged by the governments to start to issue green bonds, they're doing it for the first time. So they're coming to talk to investors and saying that, what do you want for my portfolios? What do you want to see in my green bonds? It is more of an education. It's a two-way thing, right? And I think, Sam, you mentioned earlier, investors are learning, they're becoming more aware about this. I think it's the same thing for some corporates in Asia as well. They're learning the rules of the game as we go along. So I think Asia, some see it as probably a step back, maybe in terms of the pace of development or the level of development, but probably catching up quite quickly. And government support in this area has been crucial. When I look at the amount of green bonds China has issued, say in the last couple of years compared to 5 years ago, it's been remarkable growth. So I think taking the example here from China and some of the North Asian markets, some of the markets like, say, Singapore as well, has started to try to catch up. So I think that the market will start to deepen, will start to broaden. And I think these markets will then start to appear more, feature more on the radar screens, I think, for most investors.
Great. We are a retail-facing direct-to-consumer platform. So, a lot of questions from retail investors inevitably focuses on returns. One question that I prepared was, how did the ESG strategies hold up during March of 2020 when we saw significant volatility in the fixed income space, unprecedented in many areas. But we also have questions in the audience asking, why is the return of ESG fixed income higher than non-ESG, if it's true? And does it mean the entities pay a high interest rate, or are there less credit defaults? That's one question. Another one at the bottom is saying, how much of recent ESG outperformance is it really driven by just inflows of, assets into these instruments and funds? Is demand greater than supply versus actual real value drivers? A question that was posed that we could kind of tie into it is, what is the impact of interest rates, especially recently, the short end rising, or, how the interest rate movements affect, performance as well. So maybe general performance question. Maybe we can begin with Eric, and then or Marika hasn't spoken for a while, right? So who wants to go first? I don't know.
Find either way.
I'm happy to jump in. So it's a really interesting question, this performance topic. And actually, I think, at J.P.Morgan, we have an interesting kind of case study, if you will, because as I mentioned, our sustainable fixed income strategy that we manage is an explicitly sustainable version of our flagship unconstrained portfolio that we've been managing for a number of years. So we have two very similar portfolios. The only difference is their sustainability profile that we're running in conjunction, especially over the course of last year during the extreme market volatility. And what we saw comparing the performance of those two strategies is that our sustainable strategy did outperform during the market downturn by quite a significant amount. And it outperformed the broader fixed income universe as well. If we think about high yield market, the emerging market space, investment grade credit, et cetera. So I think there's a case to be made for that. But again, that's during the period of significant market volatility. So in terms of the question you asked, Sam, in terms of, are you getting higher interest rates, or is it, fewer defaults? Admittedly, not that we're experiencing defaults in either of our portfolios, but I think it's more of that latter part. It goes back to this element of downside protection to some extent, just given the fact that you're focusing typically on higher quality companies and countries. There is a little bit of that quality bias. And so there is an element of them being able to outperform. But I do think it's really important to just know what it is that you're investing in and the different markets, right? So you think back to March last year, what happened in broader financial markets. One of the key dynamics was we saw oil, admittedly for a very brief period, but go into negative price territory, right? So if you have a portfolio that is inherently avoiding some of those more fossil fuel oriented sectors, it would benefit in an environment like that. If there's an environment where oil prices move significantly higher, then you could see some element of underperformance. But again, I think there's an element of it goes back to your investment horizon, why you're investing in these types of strategies. And over the long run, there have certainly been cases made that sustainable strategies will outperform, their quote unquote non-sustainable counterparts.
Yeah, I mean, I can confirm that observation. So we also have, let's say, alongside our SCG global credit portfolios, mainstream global credit portfolios. I think we have a similar observation. If you look at last year, that the SCG credit portfolios outperformed the mainstream and the index in the downturn. Actually, we also see them outperforming over a longer period of time, a couple of years. And what is interesting to see, it's really about, not just avoiding energy names, because indeed you will see an effect there as well, but it's also about, banks with a poor assessment given corporate conduct. It's about utility companies, automotive companies. So it's a combination of, you could say, old school business models, but also poor corporate behavior, which are the companies that have underperformed. And at longer term studies that we did on a sector level, we do see a link between this negative SCG assessment and more defaults and more downgrades. So clearly, but it's more, you could say, even more pronounced when you see this market volatility. So indeed, the same observation.
Lupin, do you want to add to the comments? Actually, we're coming up to the hour and some of us have to leave immediately, I know. So maybe, Lupin, you can comment also on this performance aspect and how we can enhance performance. Maybe the engaging part as well, you can comment on as well together.
Absolutely, sure. So I think that on the performance side, we've done a lot of research on this, both on the corporate and the sovereign side. And what we can conclude is ESG-oriented strategies do not necessarily detract from performance, even in very, very specific asset classes like emerging markets. And as we've noted before, during periods of volatility, ESG-oriented strategies can often outperform. I think the question is still out there in terms of whether this outperformance in recent years is related to the inflows that are coming into this asset class. Over the last couple of quarters, we are seeing the greenium essentially compressing quite significantly, which suggests that perhaps, in the next couple of years, we'll really be able to test the audience question as to whether it's because there is a greenium that and a kind of buy to hold orientation for holders of these types of bonds, which is resulting in the outperformance and lower volatility of the asset class. It's still a nascent asset class, and I think the next couple of years will shed important light as to the directionality. Theoretically, I agree that if you are looking at greater risk mitigation, greater engagement with issuers, that should help returns on a risk-adjusted basis over the longer term, as well as impact. I think we haven't spoken much about engagement, but engagement is one of the key pillars of how I believe fixed income investors can have an impact in outcomes for issuers. And here, I think it's a very interesting area because engagement is one of those facets of ESG investing where you really have a significant amount of coordination with your peers across the asset management groups, as well as international bodies. So it's not solely, buy-side asset managers interacting with issuers on a one-to-one basis, which is something that PIMCO does a lot. But in addition, there is a communal aspect to this, and essentially working with other asset managers to influence outcomes in issuers, particularly in sovereigns, where perhaps influence is much harder than in a corporate credit setting.
Okay, wonderful. Victor, can you wrap us up with why we should be investing sustainably?
I've got the easy part then. So I think what has come across very clearly today, the message is that if you invest sustainability, you're looking for quality, you're looking for risk mitigation, you're looking for resilience. And I think these are facts. I think these have been proven to add value to any portfolio. And I know we've talked about equities and fixed income, but I think where we all agree that these common threats, right? Looking for companies that are better prepared for the challenges of the future, lowering the default risk mitigation, and identifying a quality company is something very much in the field of sustainable investing. So I think as this continues to develop and evolve, as long as we keep to these core principles, and I think you have different strategies that come up and spout up, but if you stick to these core principles of sustainable investing, and I think performance will follow. I think investors are becoming increasingly aware, and I think they're coming on board now that yes, this is probably the way to go. We have great challenges, and these challenges, if approached properly, actually are opportunities, right? These are investment opportunities now with the right strategies. So I think sustainable investing is not something whether you should do, it's probably something that you have to do now. And I think probably the time is really right now to do that.
Wonderful. Thank you for wrapping us up. I see the poster behind Eric saying there is no recovery without sustainability. Great line. But also, it's about growth as well, right? There's no growth without sustainability, especially long-term growth, as a species, as a planet, and as a, humanity. And I think financial markets also, sustainable growth is something that is really at the heart of what we're trying to do. And so I'm really pleased and excited that we're partnering with wonderful partners who are the global leaders in this space. And I think that today's session was really helpful for our audience in seeing your wonderful capabilities and your unique attributes as well. So thank you everyone for joining us today, Marika, Lupin, Eric, and Victor. Maybe final goodbye.
Thank you for having us.
Thanks very much.
Join us on the journey. Thank you.
Okay, wonderful. Thank you, everybody. And that just leaves me to say good night, everybody. Thank you for joining us to this wonderful session today. This is recorded, so if you missed any part of it, please go to our YouTube channel to watch it. You can also watch our equities session last week and the introduction to the Endowus Sustainable Portfolios 2 weeks ago, which are all available. And please sign up below if you have any questions or want to reach out to Endowus MAS representatives. Thank you very much and have a wonderful evening.
Thank you. Bye-bye.